$121.64. Just pause for a second and think about the sheer magnitude of that number. In January of 2026, silver absolutely shattered all expectations, surging to this dramatic all-time high and honestly just dominating the global financial headlines. It was everywhere.
But, markets are nothing if not humbling, right? Today, as of May 2026, the reality is a pretty stark contrast. We're looking at prices hovering right around $84. We are talking about a massive, historic pullback that has left a lot of investors scratching their heads and searching for answers. What exactly triggered this extreme volatility? And more importantly, what happens next?
Well, that is exactly what we're mapping out in today's explainer, the silver tug-of-war. From that $121 peak to our 2026 roadmap, we are going to dive straight into the latest global institutional data to decode silver's wild ride and charts out its future trajectory.
Let's start with Section 1, the silver price roller coaster. We saw a massive 55% whipsaw in Q1 alone.
Section 2, a tale of two metals, the monetary and the industrial.
Okay, let's dive into this. Silver possesses this incredibly unique dual identity. While gold and silver are often called sister metals, and they do historically move together, silver essentially trades like a highly leveraged version of gold. Because of its smaller market size and its dual role in both finance and manufacturing, when gold moves on fear, silver tends to move 2 to 3 times as fast. It reacts violently to both monetary policies and global manufacturing data.
For those of you tracking these metrics, this is one of the fastest compression moves we've seen in recent years. Back in October 2025, it took 83 ounces of silver to buy just 1 single ounce of gold. But by April 2026, that ratio compressed all the way down to 62 to 1. That just proves how vastly silver outperformed its sister metal during that insane run-up.
All right, Section 3, the 6-year supply deficit. Let's look at the physical market realities.
To really understand this outperformance, we have to look under the hood of the global physical market. We are now entering our 6th consecutive year where global demand entirely outstrips supply. For 2026 alone, institutions are forecasting a massive 46 million ounce shortfall. Guys, this is not just a temporary market glitch, it's a persistent multi-year structural deficit. So the crucial point is that these annual deficits compound. Since 2021, we have seen cumulative drawdowns from above-ground stock inventories reaching nearly 762 million ounces. To put that staggering number into perspective, that represents roughly 9 entire months of global mine output that has literally just been wiped out. It's severely tightening the physical market.
Now, you might logically be wondering, hey, if prices are so high, why don't miners just dig up more silver? Well, look at this breakdown. A massive 70% of silver is actually mined merely as a byproduct of extracting gold, copper, and zinc. Only 30% comes from primary silver mines. This means supply is incredibly inelastic. Miners just can't flip a switch and produce more silver just because the price spikes. It doesn't work like that.
Which brings us to Section 4, powering the future. Let's talk about technological demand.
On the other side of this tug-of-war is demand. Industrial applications now make up roughly 60% of total silver demand, and we are tracking 3 massive megatrends driving this: solar photovoltaics, battery electric vehicles, and the absolute explosion of data centers and artificial intelligence. Silver isn't just a shiny rock, it's absolutely critical to both the green and digital transitions.
Seriously, silver is the foundational metal for the next generation of technology. Because of its completely unmatched electrical conductivity and its resistance to corrosion, high-tech applications, like AI data centers, which require massive computing power and heat management, not to mention 5G infrastructure, they simply cannot function efficiently without it.
And this strain extends heavily into the automotive sector. Here's a truly surprising fact. Battery electric vehicles use 67% to 79% more silver than your traditional internal combustion engine cars. With the EV transition accelerating globally, automotive silver demand alone is on track to hit a whopping 94 million ounces by 2031.
Now, what's really interesting about this slide is the double-edged sword of these high prices, specifically over in the solar industry. It's a phenomenon called thrifting. When silver prices spike, solar panels actually become too expensive to profitably produce. As a result, manufacturers are forced to substitute with copper or actively try to reduce the silver content. In fact, this thrifting effect is estimated to drop solar PV silver demand by about 19% this year alone.
Section 5, the 2026 price roadmap. Let's look at the expert bank forecasts.
So, where does that leave the market? When we look at where the heavyweight banks see the price settling, there is a super clear divide based on these conflicting forces.
On the very bullish side, Citigroup targets $110 in the second half of the year, driven heavily by those acute physical shortages we just discussed. But contrast that with UBS, who actually downgraded their year-end target to $80, citing the exact demand destruction and solar thrifting we just covered. Meanwhile, JP Morgan kind of splits the difference, forecasting an $81 full-year average.
Mapping out the rest of 2026 month by month, we see a path fraught with macro hurdles. We're currently consolidating around that $84 mark here in May. Moving into June, markets are going to react heavily to the FOMC meeting. July and August will really test industrial demand as the typical summer trading doldrums set in. September brings the expiration of the 90-day US-China tariff truce, which is a major pivot point. Then, as we navigate through October and November, global manufacturing data and election volatility will dictate the physical squeeze, culminating in December where the market heavily depends on potential end-of-year monetary easing.
And that monetary easing is currently hitting a massive roadblock. Real yields dictate silver's short-term price movements. When the April CPI came in surprisingly hot at 3.8%, the probability of a June Fed rate cut completely collapsed down to under 8%. This sticky U.S. inflation data has temporarily paused silver's massive early-year rally, keeping interest rates higher for longer.
Which brings us to the ultimate cliffhanger for this market. With silver caught in this epic tug-of-war between its undeniable industrial realities and the shifting winds of global policy, everything hinges on these upcoming catalysts. So I leave you with this final thought to consider as we wrap up this explainer. What will be the silver price after the Beijing summit?